Welcome back everyone to my world of stocks. Got just a quick little educational kind of video for any beginners out there today. So I had someone recently ask me about bonds, what my opinion is on them, how do they compare to stocks, and a couple of other things. So for today's video, I'm just gonna quickly answer 5 simple questions that are related to bonds. So number 1, we'll answer what are bonds. Number 2, how do interest rates and inflation affect bonds? Number 3, what is the bond yield curve inversion and why does that suggest that a recession might be coming soon? Number 4, how do bonds compare to stocks? And number 5, should any stock market investors also be investing in bonds? So I hope you guys enjoyed this video. I'll put chapters down in the time bar in case you want to jump around. But if you do enjoy the video, hit that like button. Let me know if you'd like to see more educational videos in the future. I think once in a while it's kind of fun to switch things up. But let's go ahead and start tackling these questions one by one. All right, so first up here, what are bonds? Well, the easiest way to think of it is that they're essentially loans being taken out by companies and governments from us, the investors. We let them borrow our money, and in exchange, they give us a bond, which is basically just like a contract that says they will pay us back all of our money plus some interest in the form of what we call coupons, which are just additional payments at a fixed amount. So for example, say we buy a $100 bond from the US government and interest rates are around 5% at the time, then they'll agree to pay us a $5 coupon every year, which earns us that 5% interest. And by the way, that coupon amount never changes. However, the yield can change based on the price of the bond, which I'll talk more about in just a second. But in general, this is why government bonds are considered to be some of the safest investments out there, because in this case, the entire United States Treasury would essentially be guaranteeing that they will pay us back the principal $100 amount on the maturity date, which is when the loan ends. So for example, let's say that this particular bond that we purchased is a 10-year government bond. Well, that means that every year we'd be collecting that $5 coupon, and after the 10 years pass and it hits the maturity date, then the government will also pay us back the original loan amount of $100. Hence why it's such an attractive investment, because we're guaranteed to get all of our money back plus interest. Now, in the open market, investors of bonds can also trade all of these bonds back and forth at different prices, which depends on how attractive each individual bond is. And that's going to depend on how safe or risky they are, how reliable a company or government is that issued that bond, what is the length of the bond, what's the yield of it, which is also affected by the length and other outside factors too, like inflation and interest rates and the health of the economy. All of these different factors can influence the price and the yields of bonds in the open market as well. And that's actually going to bring us to the second question that we have here, which is how does inflation and interest rates affect bonds? Well, if you have high inflation, which we do currently have right now, and you're trying to combat that inflation by raising interest rates, which we are also doing right now, well, what that's going to do to bonds is basically two things, depending on whether it's new bonds or already existing bonds. Now, with new bonds, it's going to make them have higher coupon amounts because of the high interest rates, which in turn is going to make those new bonds more attractive than the older bonds who are stuck with smaller coupon amounts that are already built in. Again, remember, coupon amounts do not change, but the yield can change. So what ends up happening is, in order to compensate for that, is that the price of already existing bonds is going to go down so that the coupon is worth a larger chunk of that price, and that's going to increase the yield so that it can be a little more attractive and it can better compete against the new bonds. Now, I know all of this sounds a little tricky, but the main point is that as interest rates go up, the bond prices, already existing bond prices, are going to go down so that their yields can rise and keep up with the higher interest rates. Now, if you can hold your bond to maturity, then none of this would really matter too much because you'll get your money back at the end of the loan. That's why bonds are considered safer, because you just have to really hold until maturity, even if they're down. However, if you need to sell them early, like we saw happen with some banks that had liquidity issues recently, and they had to sell their bonds early, even though bond prices were going down, they had to sell them for a loss. Well, that can actually cause some damage to the economy, and it did to these big banks. In fact, several banks actually collapsed and went under earlier this year for that exact reason. Speaking about the economy, though, question number 3 is, what is the bond yield curve inversion and why is it signaling a possible recession? Well, what this refers to is long-term bonds having lower yields than short-term bonds, causing an inversion in the yield curve. See, generally a yield curve between long-dated bonds like the 10-year Treasury bill and short-term bonds like the 2-year Treasury bill will have an upward slope to it, showing that the longer the bond is, the more interest that issuer is going to pay you, because they obviously want more time to pay you back. You'd rather it be a shorter loan, but if it's going to be a longer one, then they're going to reward you by paying you a higher yield, a higher interest on it. However, an inversion happens when we start raising interest rates by a really sharp amount, which we're currently doing, and it causes the opposite effect, where demand for long bonds is so strong that it sends their prices climbing while their yields fall, and they become even less than that of short-term bonds. And the reason why this happens is because it's basically bond investors making a prediction that the economy will get worse over time, thus causing the Fed to lower interest rates in the future, which will in turn lower the rates of any new bonds. So what the investors are doing is they're locking in the long-term bonds right now at their currently high yields because they see interest rates are high right now. They think that Fed is going to lower rates. They'll get lower in the future. So they're thinking, okay, I'll buy these long-term bonds right now with locked in coupon rates, high yields that are very high, and I'll have those for the long term. But what that's doing is that's sending demand for long-term bonds higher, which is increasing their price and in turn lowering their yield. Again, when price goes up, yield goes down. And at all the meanwhile, short-term bonds are in less demand, so their prices are going down, but that's sending the yields higher, and that's when you end up with an inversion, which looks like this. This is a chart showing the difference, or what we call the spread, of the shorter 2-year government bond yield versus a longer 10-year bond. And as you can see, it's currently inverted at a negative rate. So why is this a big deal? Well, since the late 70s, a yield curve inversion like this has accurately predicted a recession every single time, which is partly because inversions tend to hurt banks who rely on short-term borrowing and long-term lending, but because the rates are inverted, they become more reluctant to lend out to big businesses long-term, which ends up slowing down the economy. And probably the biggest reason of all is just that it's a self-fulfilling prophecy. If everyone thinks that a recession is coming, they start to spend less and be more cautious with their money, which ends up hurting the economy, since more than or around 70% of the economy is consumer driven. Now, typically a yield curve inversion takes around a year to a year and a half before a recession actually hits. And as you can see on this chart here, we've now been inverted for just a bit over a year. So if the model proves correct again, then a recession would be hitting very soon. It's not guaranteed though, and as a long-term investor, I try to stay away from making these type of short-term predictions, but it is still something that I think is worth definitely paying attention to. Now, with all of that said though, let's finish up now with the 2 final questions, and I'm just going to combine these into one because they're so related to each other, but that's basically, how are bonds different from stocks or different to stocks? And should stock market investors also be investing in bonds? Well, right off the bat, I can tell you that bonds are usually a very good investment choice in a portfolio because it can offer a little bit of diversification, adding another type of investment in there, but it can also add some safety to your portfolio as well, especially if you're investing in a very safe government bond from a pretty reliable country like America. I mean, think of it this way. If you were to buy stock, right, you're buying a part of a company. Well, that company can definitely go bankrupt and go under and completely collapse. But the chances of an entire country like America completely collapsing is definitely not as likely. And if America was to completely collapse, chances are that that company you bought stock in probably collapsed too. So you'd have other issues anyway. So overall, I just think that government bonds, especially American ones, I feel those are pretty safe and can generally be a good addition to anyone's portfolio if you want to go that route. However, this may surprise you to hear though, but I actually don't own any bonds myself. And it's not because I have anything against them. I actually do plan on investing in bonds in the future whenever I get around to it. But at the moment, I've been having so much fun investing in stocks instead, where I feel that the gains potential is so much higher. Definitely has a bit more risk, but again, the reward potential is just so much more attractive to me. I'll give you some examples here. I mean, bonds, we know that they are usually yielding around 5% or so, give or take, the most popular ones, American ones. But when you look at some of the stocks that I own, I mean, one of my best ones is Tesla, who I've owned for years now, but I am up over 1,000% on that stock. And I'm sorry, but you're just not going to get those type of returns from bonds. And it's not just stocks, just the stock prices themselves. It's also dividends. I actually think dividend stocks are more attractive than bonds too. Take for example AbbVie stock, which is a biotech that I own. When you look at their stock, so my average cost basis on it is $67 per share on my position. Well, today AbbVie stock trades for $138, and they pay a dividend of $6.20 per share per year. So if we do some math on this, that means that I am up over 100% on my position, and I'm also collecting dividends worth over 9% every single year on top of that. So again, you're just not going to get those type of returns from bonds, and that's why I usually stick with stocks. But anyway, just to kind of summarize here, again, bonds can be a very solid type of investment to diversify your portfolio, can also be relatively safe if you choose the right ones. But stocks, in my opinion, are funner, more attractive, and have more reward potential. So I usually go that route myself. But if you have any other questions, drop them down below. I'll try to answer as many as I can. And if there's any other educational topics you'd like me to give my opinion on, I'd be more than happy to. Just drop those comments down there as well. But thanks again for stopping by, my friends. Thank you for all your support. It means the world to me. Hope you're all doing well, and I'll catch you in the next one. Take care. Bye-bye.